Have you ever wondered what it really means to hold 1,000 HBR in 2026, and whether this small-looking bag is just another cheap altcoin position or actually a quiet stake in the infrastructure that could end up powering global finance? And why is it that most retail investors still scroll past a 9-cent token without a second thought, while institutions and enterprise giants continue building on the same network behind the scenes? And could it be possible that what looks insignificant today is actually early access to a system designed for trillions of dollars in tokenized assets, AI-driven transactions, and machine-to-machine payments that are already starting to reshape the digital economy? Owning 1,000 HBAR is not simply about buying a cheap crypto token or grabbing another speculative altcoin. It is about securing a small but meaningful position inside the machinery that could end up running the global digital economy. Because while most retail investors glance at HBAR and see a low-priced coin sitting quietly under 10 cents, the smartest institutions and enterprise players are looking at the exact same asset and seeing infrastructure, territory, and an early-stage land grab for the rails of the future financial system. And now here we are in February 2026, where Bitcoin is still trying to reclaim its march towards six figures. Ethereum continues to operate as the high-fee playground for elite traders and DeFi whales, yet Hedera is sitting there priced like a rounding error in comparison. With roughly 9 cents per token, meaning that a 1,000 HBAR bag costs less than a decent pair of sneakers, making it look small, almost irrelevant, like a participation trophy in the wider crypto race. But that appearance is exactly where the illusion lives, because you are not just buying a digital coin here. You are buying exposure to a high-speed financial rail system that is already being reserved and utilized by Fortune 500 companies and global enterprises. What this situation reveals is a massive disconnect between what the market is currently charging for access to the network and what the network is actually doing behind the scenes. Because while retail traders continue chasing hype-driven pumps on trend-heavy chains and meme ecosystems, Hedera's transaction activity continues to run quietly in the background at a scale that often dwarfs competitors, showing that the engine is already operating at full throttle even if the price chart has not yet caught up with that reality. And this brings us directly to one of the most misunderstood aspects of the entire project, which is the 50 billion token supply that often scares off newer investors who see the number and immediately assume that such a large supply prevents meaningful price appreciation. But that assumption comes from applying outdated scarcity logic to a network designed for billions of machine-to-machine interactions where scale is the priority rather than artificial rarity. Because when a ledger is built to handle millions of events per second and support global enterprise usage, the large supply is not a weakness but a structural necessity that allows the network to function smoothly at worldwide scale. Hedera is not attempting to become just another speculative cryptocurrency riding social media cycles and influencer hype. It is positioning itself as the trust layer of the internet, a system where people, corporations, and machines can interact with verifiable confidence and predictable costs. And if you judge HBAR purely by today's market price, you are essentially looking at a high-performance supercar and complaining about the cost of the key instead of recognizing the value of the machine it unlocks. Because that roughly 90 required to acquire 1,000 tokens is not simply a small retail trade. It represents a seat at the same network table occupied by companies like Google, IBM, Dell, and other enterprise giants that are participating in governance and infrastructure development, making it a strategic position inside a network where value is being driven more by real-world usage and transaction velocity than by short-term speculative hype cycles. The key principle that underpins this entire narrative is the concept of velocity over scarcity. Because when billions of microtransactions and automated events begin flowing through a system every single day, the total token supply becomes far less important than the demand for the gas required to power that system. And in Hedera's case, that gas is HBAR itself, which means that as transaction activity scales, The demand for tokens to fuel those operations grows alongside it. And this is why many analysts believe we are moving out of the era where speculative gems dominate attention and into an era where utility-driven giants begin to take center stage, turning that seemingly small 1,000 Hbar holding into something more than just a cheap bag of tokens, and instead into a ticket to one of the most sophisticated distributed ledgers ever constructed, raising the real question of whether investors have the vision to recognize the skyscraper while the foundation is still being poured. Because trillions of dollars in traditional finance are currently searching for efficient digital infrastructure, and Hedera has positioned itself as one of the platforms capable of supporting that transition. The shift we are witnessing in the financial world is not just about digital gold narratives anymore. It is about tokenized buildings, tokenized bonds, tokenized funds, and entire segments of traditional finance moving onto blockchain-based rails, creating what is commonly referred to as the real-world asset, or RWA market. And while many competing networks struggle with congestion, unpredictable fees, and scaling limitations, Hedera is attempting to position itself as the plumbing for this massive migration of value, with the opportunity size being enormous, given that traditional financial markets represent tens of trillions of dollars that could eventually be tokenized. And even at this early stage, we are already seeing tangible examples of adoption, such as Red Swan moving billions of dollars worth of real estate onto the ledger, Arcax minting tokenized funds from major asset managers, and the October 2025 launch of the Canary Hbar ETF, creating a direct bridge that allows institutional capital to flow into the network in a regulated and structured way. This is not a test environment or a distant future concept. It is an active deployment phase where tokenized assets are already live on the network and institutional participants are already interacting with the system. And each institutional purchase of Hbar for operational use effectively locks up supply and reduces the amount available on open markets, creating a form of continuous buy-side pressure that many retail traders fail to notice because they remain focused on short-term chart movements rather than long-term structural demand. And as more real-world assets migrate onto the ledger, the demand for Hbar as the required transaction fuel increases, transforming the token from a purely speculative instrument into a functional resource that entities must hold in order to operate within the ecosystem. Meaning that owning 1,000 Hbar is not just a bet on price action, but ownership of a small portion of the bridge through which tokenized value flows, with every crossing requiring tolls paid in Hbar. Looking ahead to the evolution of the digital economy, it becomes clear that machine-to-machine transactions will play a major role as AI agents and automated systems begin to execute trades, purchase data, and interact with each other without human intervention. And these machines will not rely on traditional banking interfaces or credit cards, but will instead require predictable costs, high-speed verification, and tamper-proof audit trails, which is where Hedera's fixed fee structure and consensus service become particularly relevant because they allow companies running millions of automated checks to operate without worrying about unpredictable gas spikes. And as we move deeper into the AI-driven era, the importance of data provenance grows significantly, since AI systems must be able to prove where their training data originated and provide verifiable logs of decision-making processes, making Hedera's consensus service function as a kind of global timestamping and verification layer that can serve as an audit log for the AI economy. Developers are already building AI agents and automated wallets capable of holding Hbar in order to pay for verification, timestamps, and microtransactions, meaning that each automated action could require a fraction of a token, and when this activity is multiplied across billions of agents, the cumulative demand becomes substantial, raising an important question about whether the requirement for AI systems to maintain token balances for verification and settlement could eventually create supply pressures that retail investors are not currently pricing in. And this ties directly into the mathematical side of the discussion, where many investors still focus solely on total supply without considering velocity and usage demand, even though Hedera's fee model is denominated in USD but paid in Hbar, ensuring that as transaction volume grows, more tokens are required to fuel the network, creating a kind of vacuum effect that pulls tokens out of circulation. Even with a large total supply, sufficiently high usage velocity can support price growth, and when staking rewards of around 2.5% are factored in, long-term holders are effectively earning yield on what can be viewed as a piece of global digital infrastructure. And within dedicated communities and research groups where real-time alerts and technical analysis are shared, the focus tends to be on long-term adoption trends rather than short-term volatility. Because if Hedera captures even a modest portion of the global RWA and machine economy markets, the valuation potential extends far beyond current levels and begins to enter discussions of multi-dollar price targets, with some projections suggesting that even at 10 per token, the network's valuation would still remain lower than many established technology giants, indicating that such figures may not be as unrealistic as they initially appear. Scarcity in this context is not solely about token count, but about access to network functionality, because when banks, AI systems, and enterprises need Hbar to operate, they must obtain and hold tokens. And while critics often point to Hedera's corporate governance structure as evidence that it is less decentralized than other networks, supporters argue that enterprise adoption requires accountability, stability, and legal clarity rather than anonymous operators, which is why a governing council composed of major global companies can actually serve as an advantage in attracting institutional participation. And from a personal security standpoint, it is also wise for users to maintain multiple exchange accounts and access points to ensure redundancy in case one platform becomes unavailable, reinforcing the idea that security involves not just the ledger itself, but also user access to it. As always, it is important to emphasize that none of this constitutes financial advice, and that cryptocurrency investments carry significant risk, requiring individuals to conduct their own research and only invest amounts they can afford to lose. But when zooming out to a broader time horizon, it becomes evident that while crypto markets move quickly on a day-to-day basis, global infrastructure adoption unfolds over years, and institutions are generally less concerned with short-term price spikes and more focused on building systems that can operate reliably over decades, following an S-curve of adoption where early integration eventually gives way to rapid expansion once a critical threshold is reached. And by the end of this decade, it is possible that many users will interact with Hedera-powered systems without even realizing it, as the technology becomes embedded in supply chains, financial products, and AI services in a way that feels invisible yet essential. This long-term perspective helps explain why some institutional wallets have continued accumulating tokens even during market downturns, while retail participants frequently sell during periods of volatility. And although the path to 2030 is unlikely to be smooth and will likely include cycles of doubt and negative sentiment, those with multi-year horizons may view such periods as opportunities to strengthen positions in a network that aims to serve as settlement infrastructure for tokenized assets and automated transactions. And at that scale, the comparison shifts away from speculative altcoin valuations and toward the valuation of financial infrastructure itself, where demand for the token becomes functional rather than purely speculative because every transaction consumes Hbar and rising usage naturally increases demand regardless of broader market conditions. Holding 1,000 Hbar today might feel modest, but if network adoption and transaction velocity continue to expand, that position could carry significantly more weight over time, prompting the broader question of why many retail investors remain hesitant to engage with a network already being utilized by major companies and institutions. And when the cheap token illusion is stripped away, what remains is a platform that is gradually evolving into a piece of global digital infrastructure, with growth driven by regulatory clarity, enterprise adoption, and expanding use cases in AI and tokenized finance. supported by metrics such as increasing wallet counts, rising transaction volumes, and institutional participation that suggest a resilient underlying structure even during periods of market volatility. Ultimately, the definition of a meaningful investment varies for each individual, but for some investors, a 1,000 Hbar holding represents a small diversified position, while for others it reflects a high-conviction bet on the future of AI-driven economies and tokenized real-world assets. And as more of the total supply enters circulation and more transactions occur on the network, the narrative shifts from speculative potential toward functional utility, positioning Hedera as a conservative yet potentially high-impact bet on the long-term decentralization of trust and value exchange. And while short-term price movements may continue to fluctuate, the broader trajectory will likely depend on adoption rates, institutional involvement, and the continued expansion of use cases across industries ranging from finance to artificial intelligence. Now that you understand the deeper context behind the so-called 90 illusion and the potential role of Hbar within evolving digital infrastructure, the next step is to consider how this position fits into the wider institutional and technological landscape that is currently taking shape. This video is for educational and informational purposes only and should not be considered financial advice, because cryptocurrency markets are highly volatile and involve significant risk, and you should always do your own research before making any investment decisions, while only investing money that you can afford to lose, as the ideas discussed here reflect analysis and opinions about potential future developments rather than guaranteed outcomes. And neither this channel nor the creator is responsible for any financial decisions made based on this content. So, always consult with a qualified financial professional if you are unsure about your investment strategy.